Why do some countries go broke while others can carry trillions in debt without breaking a sweat? Today, we're breaking down sovereign default risk, the science of predicting when a government might stop paying its bills. We'll look at the red flags and how the big rating agencies actually grade a nation's creditworthiness. First, what makes a country risky? It starts with the level of indebtedness. Think of country A, with a GDP of 500 billion but a debt of 750 billion. That's a 150% debt to GDP ratio. It's a massive burden, but it's not the only factor. Next, we look at hidden commitments. If country B has a rapidly aging population and has promised 100 billion in future pensions but hasn't saved a dime, their default risk quietly climbs every year. Then there's the tax base. If country C has a diverse economy, tech, farming, and manufacturing, its revenue is stable. But country D, which relies entirely on coffee exports, is in trouble if global coffee prices crash by 40%. Without diverse taxes, the government's wallet stays empty. Politics plays a huge role. Democracies are generally incentivized to pay their debts to keep voters happy and markets open. In an unstable autocracy, a leader might simply wake up and decide to stop paying because it suits their agenda. However, some countries have a safety net. This is called external backing. If a small nation is part of a powerful group, like the EU, markets often assume its wealthier neighbors, like Germany, will step in to prevent a total collapse. It's an implicit guarantee that keeps interest rates lower than they probably should be. So, how do agencies like S&P and Moody's actually assign a grade? They look at two distinct categories, local versus foreign currency. A country's local currency rating is usually higher. Why? Because if country E owes a million pesos, it can technically print more pesos to pay it off. But if it owes $1 million, it can't print those. It has to earn them through trade. That foreign currency rating is the real indicator of default risk. The process is rigorous. A committee of 5 to 10 experts debates the data before voting. While S&P focuses on the probability of default, Moody's looks at both probability and severity. Essentially, how much will investors actually lose if things go south? The data says yes, there is a massive correlation between a low rating and a real-world default. Historically, an AAA-rated country has almost a 0% chance of defaulting over 15 years. But once you drop to CCC status, that's junk territory. Data shows that over 80% of countries in that bracket will likely default in a short window. Finally, watch out for the contagion effect. If one country in a region defaults, agencies often review its neighbors immediately. Even if country G is healthy, the panic from country F next door can spread like a financial virus. Sovereign risk is about more than just numbers on a balance sheet. It's about political will, demographic shifts, and global connections. Thanks for watching, and I'll see you in the next deep dive into the world of risk.